One of the most powerful wealth building strategies in commercial real estate has nothing to do with collecting rent. It comes from understanding something most newer investors completely overlook: cap rate compression. Because sometimes investors buy a property at an 8 cap and sell it years later at a 6 cap. And when that happens, the value of the property can increase dramatically, even if the income only increased modestly. That's one of the reasons sophisticated investors pay so much attention to trends, markets, brands, demographics, and long-term positioning. Because in commercial real estate, sometimes the real money is made not just from the income, but from how the market eventually values that income. And if that sounds confusing right now, don't worry. By the end of this video, you're going to understand exactly how cap rates work, why they matter so much, why investors obsess over them, and how understanding them can completely change the way you evaluate commercial real estate. Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, a commercial real estate broker and business broker working with investors nationwide. And today I want to explain cap rate in a way that actually feels practical, strategic, and real-world applicable. Because most people learn cap rates like a math formula, but sophisticated investors think about cap rates as a story about risk, a story about confidence, a story about future expectations, and ultimately a story about where the market believes value is going. So let's break this down. Let's start with the basic definition first. A cap rate, short for capitalization rate, is simply the return a property produces based on the income it generates relative to the purchase price. That's it, the simple formula. Cap rate equals net operating income divided by purchase price. So if a property produces $100,000 per year in net operating income, also referred to as NOI, and sells for $2 million, the cap rate is $100,000 divided by 2 million, which equals 5%. Now, at first glance, this sounds very simple, and mathematically, it is. But what makes commercial real estate fascinating is that cap rates are not really about math. They're about perception, because the market is constantly asking one giant question: how confident are we that this income will continue? And that question changes everything. Let me give you a very practical example. Imagine two restaurant properties sitting across the street from each other. One is a brand new Starbucks with a corporate guarantee, excellent traffic counts, a long-term lease, affluent demographics, and a high visibility corner location. The other is an older local restaurant with a weaker operator, a shorter lease term, and less predictable long-term stability. Now here's the interesting part. The local restaurant may actually produce more income today, but investors may still be willing to pay dramatically more for the Starbucks. Why? Because the market perceives the Starbucks income stream as safer. And when investors perceive lower risk, they accept lower returns, which means lower cap rates. This is why I always tell investors, cap rates are not just formulas. Cap rates are how the market prices confidence. And once you understand that, commercial real estate starts making a lot more sense. One of the biggest misconceptions newer investors have is assuming higher cap rates automatically mean better deals. And I understand why people think that. If one property is producing an 8% return and another is producing a 5% return, the 8% sounds better. But in commercial real estate, higher returns often come with higher risk. The market may be signaling problems: weak tenant, weak location, declining demographics, poor traffic patterns, functional obsolescence, short lease term, or weak surrounding retail. And this is where investors can get themselves into trouble, because sometimes a property is trading at a high cap rate because sophisticated investors are avoiding it. Now, that doesn't automatically mean it's a bad deal. Sometimes high cap rate properties can be incredible opportunities, but you need to understand why the cap rate is high. That's the real analysis. Experienced investors don't ask, what's the cap rate? They ask, why is the cap rate what it is? That's a completely different level of thinking. Now let's talk about one of the most important concepts in commercial real estate investing: cap rate compression, because this is where real wealth can get created. Let's imagine an investor buys a property in an emerging growth corridor. Retail is coming in, traffic counts are increasing, population is growing, a stronger tenant eventually replaces a weaker tenant, or maybe a brand itself matures and becomes more institutionalized over time. Now imagine the investor originally bought the property at an 8 cap, but several years later, because the market perceives the property as stronger, safer, and more desirable, investors are now willing to buy it at a 6 cap. And this is where the inverse relationship becomes incredibly important. As cap rates go down, property values go up, and sometimes dramatically, because investors are willing to pay more for the same income stream. This is one of the reasons investors sometimes make enormous returns in commercial real estate, even when cash flow initially seemed modest. What investors do is they identify improving fundamentals before the broader market fully price them in. This is exactly why sophisticated investors spend so much time thinking about migration patterns, infrastructure, retail trends, demographics, tenant quality, and long-term market evolution. Because they're not just buying income today, they're trying to understand what the market may believe about that property 5 or 10 years from now. Now let's talk about interest rates, because cap rates and interest rates are heavily connected. When interest rates rise, borrowing money becomes more expensive, which means buyers can afford less property. And when buyers can afford less, values decline, which usually causes cap rates to rise. This is exactly what happened across much of commercial real estate over the last several years. Properties that may have traded for 4.5 cap during the lower interest rate environment suddenly started trading for 5.5 or 6 cap once debt became more expensive. And this is why commercial real estate investors pay so much attention to the debt markets, because real estate values are deeply connected to financing conditions. Commercial real estate does not operate independently from the broader economy, and understanding that relationship is incredibly important. Now let's talk about the difference between cap rates and cash-on-cash returns, because here's another major misconception. Cap rate and cash-on-cash return are not the same thing. Cap rate measures the property before financing. Cash-on-cash return measures your actual return after financing. So you may buy a property at a 6 cap, but after debt service, your actual year one return may only be 3%. And this surprises a lot of newer investors because they see the headline cap rate and assume that's what they're personally earning. But leverage changes everything. And this is where commercial real estate starts becoming much more strategic, because sophisticated investors are often evaluating long-term appreciation, debt paydown, inflation protection, rent growth, and future equity creation, not just year one cash flow. The single biggest mistake I see investors make is chasing yield without understanding durability. They become obsessed with the highest cap rate possible. But commercial real estate is not just about maximizing income today, it's about understanding whether the income stream will still be there years from now. And this is where investor psychology becomes incredibly important, because eventually weak properties get repriced, weak tenants fail, weak locations deteriorate, weak corridors lose relevance, consumer behavior shifts, and when that happens, values can fall very quickly. Which is why experienced investors spend so much time evaluating downside risk. They are constantly asking, how durable is this income really? Experienced investors understand that commercial real estate is really a long game of probability. They're evaluating durability, downside protection, market positioning, replacement value, tenant viability, demographic trends, and future investor demands. Because ultimately, commercial real estate is not just about buildings. It's about understanding where people want to live, work, spend money, and invest capital over long periods of time. And cap rates are one of the clearest signals the market gives us about how investors collectively feel about those trends. So if there's one thing I want you to take away from this video, it's this. Cap rates are not just formulas. They are the market's way of pricing confidence, durability, risk, and future expectations. I hope you found this helpful. And if you want more breakdowns like this, make sure you subscribe to the Commercial Real Estate Deal Room. And if you're actively evaluating investment properties, navigating a 1031 exchange, or trying to better understand how experienced investors analyze commercial real estate deals, my contact information is in the description below. I'm Mercedes Shaffer. Thanks for watching, and I'll see you in the next deal.